Hello, I'm Cashman. Let me show you how money really works.
Most retirees don't realize this, but one $10,000 withdrawal can quietly cost them thousands more in taxes, and they don't even see it happening. Here's the payoff most people miss. In the wrong income range, that same $10,000 withdrawal doesn't just get taxed once. It can trigger more of your Social Security to become taxable at the same time. That means one decision can create multiple layers of taxation instantly. That hidden chain reaction is what many planners call the tax torpedo. Later, I'll show you how to sidestep it before it drains your retirement income. Miss this, and you could lose far more than planned. Most people believe retirement taxes get easier. They think saving was the hard part. But retirement has its own trapdoors, and this one shows up after it's already costing you. So where does this begin? I've seen people do everything right, save consistently, invest wisely, avoid reckless decisions, and still get blindsided. Because once retirement begins, your income streams collide. Social Security comes in, IRA withdrawals begin, interest shows up, and suddenly the tax system starts stacking those pieces in ways most people never planned for. And this is where the tax torpedo starts forming. So what are most people missing? Here's the truth most people misunderstand. Social Security is not taxed at an 85% rate, but up to 85% of your benefits can become taxable income once your income crosses certain thresholds. That distinction changes everything, because once more of your benefits become taxable, your effective tax burden quietly rises, even if your tax bracket barely changes. And this is where the torpedo activates. So what triggers it? A formula called provisional income. It sounds complicated, but the idea is simple. It includes your regular income plus tax-exempt interest plus half of your Social Security benefits. That's it. But once that number crosses certain levels, more of your Social Security gets pulled into the taxable category. And once that starts, it escalates. So what happens when you take money out? When you take money from a traditional IRA, you're not just adding income. In the wrong range, you're also triggering more of your Social Security to become taxable at the same time. So one withdrawal can create two tax effects at once. That's the tax torpedo hitting. You think you're pulling money, but the system quietly pulls more into taxation. Most people never see it coming. Why? They look at balance, not interaction. And retirement is no longer just about how much you saved. It's about how your income streams collide. So what does this look like? Imagine a couple entering retirement with a strong portfolio. They've got a large traditional IRA, some investments, and Social Security starting soon. They want to travel more, help family, enjoy life. So one year they decide to take an extra withdrawal. Nothing extreme, just a little more. But that one move increases their taxable income and pulls more of their Social Security into the taxable column at the same time. Now that $10,000 withdrawal doesn't cost $10,000. It quietly costs far more. And here's the part that hits later. They don't even realize why their tax bill jumped. That's the tax torpedo, doing damage silently. So how do you avoid getting caught in it? You have to stop thinking like a saver and start thinking like an income strategist. Because in retirement, how you withdraw matters just as much as how you saved. So where is your money right now? Here's the framework you need to understand. Most retirement money sits in three tax buckets. The first is taxable accounts. These include brokerage accounts that may produce capital gains and dividends. They often give you flexibility depending on what you sell and when. The second is tax-deferred accounts. This includes traditional IRAs and 401ks. This is where most people have the majority of their wealth. And this is where the tax torpedo gets its fuel, because every withdrawal adds to your taxable income. The third is tax-free accounts. This includes Roth accounts and, in some cases, properly used HSA distributions. These accounts are powerful because qualified withdrawals don't show up the same way in your income calculations. And that matters more than most people realize. So which bucket controls your future taxes? If most of your wealth is in tax-deferred accounts, then every withdrawal is a future tax event waiting to happen. Your statement may say asset, but the tax code may say liability. And that's where people get trapped. Because they focused on building wealth, but never planned how to release it. So what gives you control? This is where strategy separates people. There is often a window, before Social Security begins or before required withdrawals increase, where your income looks lower on paper. That window is everything. Because during that time, you may have the opportunity to shift money from tax-deferred accounts into tax-free accounts. This is called a Roth conversion. And this is how you fight back against the tax torpedo. It means choosing to pay some tax now, to reduce future tax pressure later. Not all at once, not blindly, but strategically, so you stay in control. Because the goal is not to eliminate taxes. The goal is to control when and how they hit you. So what happens if you ignore this? At a certain point, required minimum distributions begin. And those distributions are not optional. They force money out of your accounts and into your taxable income, which increases your income, your taxes, and how much of your Social Security gets taxed. That's the tax torpedo hitting again, this time with more force. And here's the uncomfortable truth. Doing nothing is still a decision, and often it's the most expensive one. Because time doesn't always reduce tax risk. Sometimes it multiplies it. A larger account may feel like security, but if it creates larger forced withdrawals later, it can also create larger tax problems. And that's the part most people never plan for. Question of the day. If you were retiring with a large traditional IRA, would you rather pay some taxes now or risk paying more later? Comment below. The goal here is not perfection, it's awareness. Because the tax torpedo doesn't hit people who didn't save. It hits people who saved but didn't plan how to withdraw. So here's the shift. Stop looking at your retirement as one account. Start looking at it as a system. Look at where your income comes from and how those sources interact, and look at whether shifting future income into more tax-efficient positions makes sense. Because retirement isn't just about reaching a number, it's about keeping more of what you built once you get there. Because the biggest threat to your retirement isn't running out of money. It's losing control of it. Now that you know one withdrawal can quietly trigger multiple layers of taxation, you're going to need to know what happens when required minimum distributions start forcing income into your plan, whether you want it or not. If you don't know this, you could lose control of your tax situation in your 70s and watch more of your income disappear than expected. The secret is in my next video. The RMD landmine that can quietly drain retirement accounts faster than most people realize. You don't want to miss it. See you in our next video.